Awesome. Good morning, good afternoon, and good evening. Okay. Good morning, good afternoon, good evening. My name is Tony Martinez. I am the owner of TKO Financial Network. If you're watching this video right now, it's because you like the title, to be quite frank. And the title is focused 100% around mortgage protection leads, right? I have the privilege and pleasure of running a back office that assists many different agencies across the country in operating and running their business. Some of my agencies are focused in wealth management, high sales. Some of my agencies are focused 100% on final expense. Some of them are still, referral based type businesses, but I still have a good amount of agents that focus their attention on mortgage protection leads. Mortgage protection leads. So let's talk about that today. I got about 15 people on or so right now in this training, and I don't know how many people are going to watch the video, but take out your notepad, take out your pens, and get ready to take some notes because I'm going to give you my tips on what I do for mortgage protection. Okay. A couple things you have to understand. You have to understand the consumer that fills out a questionnaire for mortgage protection leads. You have to understand the consumer. Number one, the person that typically fills out mortgage protection lead request is a younger client. That's not your typical 65 plus final expense client. This is more your 20 to 50-year-old client, right? So when you think about the 20 to 50-year-old, you're talking about the Gen X generation, the millennial generation, the Gen Z generation, right? You're talking about that kind of generation right there. Um, that generation understands technology. They understand technology, so that's not something you have to be afraid of. If you're not a technology person, that's okay. The only limitation that you have, obviously, is the fact that you're going to be doing more belly-to-belly type meetings, or become very good at doing them over the phone. Okay, become very good at doing them over the phone, right? But if you're good with technology, you expand your business to all kinds of territories, right? Your insurance license lets you operate in 50 states plus Puerto Rico. So I live in South Florida, and I've got more clients, more agents, more business outside of the state of Florida because of this beautiful thing called virtual meetings that allow me to operate. Mortgage protection leads allows that to happen for you, right? So if you, again, like I said, if you want to run a home-based business, you want to run a virtual business, you want to run a telesales business, mortgage protection leads are the place to go, right? My agents internally within TKO's financial network have access to aged leads that are $2 a piece. And my request to everybody that purchases those is focus those on mortgage protection leads versus a final expense lead. Why? An age lead that I have access to provide to you guys, I can only control the state that it comes from. I can't control the city or the county, so I can't guarantee you that that lead is going to be your neighbor and you can just drive over there. And if you live in a big city, big state, and all states I guess are pretty big, but California, for example, Florida, Texas, where it's like 8 hours just to go from one point to the other, you might not want to take that kind of drive for a belly to belly meeting. So you want to focus on mortgage protection. Now, let's talk about the person that fills out that questionnaire. It's someone that just recently bought a home. So the biggest thing you have to understand is that there's a high likelihood that person probably doesn't have many assets. When you think about buying, first-time home buyers for in middle America, they had to save up some type of a deposit to be able to buy the house. You know, even if they got a even if they got a government mortgage, right, like an FHA loan, where that only requires about 3.5% down payment, right? California, for example, what average house is what, half a million, right? Somewhere around there. You know what 3.5% is on a $500,000 house? That's still close to $20,000 that they have to save up, right? Now that's if they win FHA, mortgage. If they win retail conventional, we're talking about 10%, 20% down type deals. So what am I trying to get at? If the person filled out a questionnaire for mortgage protection leads, chances are they've liquidated a decent amount of their assets to do it. They might have even liquidated some of their 401k money in order to do it, because a 401k does give that option for first-time home buyers, where they have to pay the taxes but not the penalties. So if they're on a tight budget, you really think that they're thinking about, purchasing something expensive. I'm not going to tell you that you're not going to occasionally find the IUL client or the GUL client. I'm just saying the majority of the people are looking for one solution and one solution only. They're looking for term life insurance. That's really what mortgage protection is. So a lot of people get confused and they say, what the heck is a final expense lead? What the heck is a final expense program? What the heck is a mortgage protection program? It's a marketing name. All it is a marketing name that was given in order to attract the people who just bought houses. Final expense is a marketing name given to a whole life policy in order to attract the people that are trying to cover what? Their funeral costs, right? A person that signs up for final expense, I promise you, is having conversations about making sure their funeral costs are covered. And so final expense, this is a good marketing name. A person who just bought a house that wants to insure that house looks for something to insure that house. So mortgage protection is a marketing name that's given. But what exactly is the product? It's a term life insurance policy. That's what it is. You sign up for a 30-year mortgage, you get a 30-year term product. You can sign up for a 20-year mortgage, you get a 20-year term product. They want something cost-effective to protect them throughout the time that they have that mortgage, right? Now, you need to educate yourself a little bit on what other people are going to jibber jabber into their ear. Remember, they just got done working with a mortgage loan officer, a real estate officer, a title, an appraiser. They got done working with all those people. You know what kind of insurances those people know about when it comes to mortgage protection? Anybody know? Sometimes it's embedded into your mortgage payment.
MPI.
Say it again.
MPI, mortgage protection insurance.
Exactly.
That's not what it is, but it protects the lender. Private mortgage insurance. There you go.
There you go.
Private mortgage insurance.
Right? PMI. PMI is the acronym, private mortgage insurance. PMI. So someone might get confused, be like, oh, I thought I had that in my mortgage already. Okay, so you need to know what to tell them. It's called PMI, right? Private mortgage insurance. What it is, it's protecting the lender, the bank that loaned you the money, not you. Do you get a benefit out of it? Yes, you do. What this insurance basically does is it says, listen, if you die, we're going to pay off the remaining balance of your mortgage. So the bank is going to get made whole, and you and whoever the beneficiary is of the home, now owns the house free and clear, right? So I'm not saying that they don't get a benefit, but they need to understand the type of benefit they're getting. Let's say they sign up for a $300,000 mortgage, and they're paying X amount of money for that PMI, okay? Now, what happens over years is that balance drops down. The balance drops down, so the balance to pay off the mortgage is a lot less. What happens to that initial amount of insurance, however, that they signed up for? It's decreasing. The insurance is decreasing, but yet the payment is still the same. So they might have signed up for $300,000 of private mortgage insurance, but as the balance drops down, they're still making the same payment, but the amount of money that that is going to pay out is less because the mortgage is paying less. Right? They need to understand that. So how would them getting their own mortgage protection insurance work? Think about this. Does term insurance decrease in its face value? It doesn't. So if I, as a consumer, sign up for a $300,000 insurance policy to pay off my $300,000 mortgage, and I have this mortgage for 10 years, and I've paid it down from $300,000 to $200,000, and then I pass away, my insurance is still going to pay my family $300,000. Still going to pay my family $300,000, right? But here's the second benefit, the second difference between PMI from a lender and mortgage protection of your own. PMI requires you to take that money and pay off the mortgage. You're not even going to see the money. The mortgage is just going to get paid. Getting your own insurance, the beneficiary now has a choice. And what's the choice? Here's what I mean by this. Watch this. Let me give you a scenario, right? Let's say Sandra and I, right? Her and I are in a relationship, but we're not legally married, right? I buy a house. The house is in my name, right? House is in my name. Insurance is in my name, but she's the beneficiary. I just took out 2 policies, and she's the beneficiary on some of them, right? If something happens to me, let's use the same scenario: $300,000 mortgage, $300,000 insurance policy. Something happens to me, I pass away. She's the beneficiary to my policy. She gets $300,000. Let's say that happens 10 years into me having the mortgage. The balance is now $200,000. She now has a choice. The choice is take this $300,000. Take $200,000 of it and pay off this house and own the house, right? Keep the $100,000 for other necessities that are needed. Or let the bank take the house. Let the bank take the house. I don't want nothing to do with the house. I'll take the full $300,000 and go somewhere else, reinvest it somewhere else, right? Where does that make sense? What about a negative real estate market? Right? What about a market where, man, I bought the house for $500,000 when the market was high, and now the market is low, I'm negative equity. The value of my house is only $300,000 now. I'm negative 200,000 from what I put into the house. If I pass away in that scenario and she gets $500,000, do you think she would want to take that money to pay off a negative house? No. Why not take that money and buy a house that's bigger and better for the same amount of money in that market? See, PMI from a lender doesn't give you that choice. It says you're paying off this mortgage no matter what, because it's protecting the insured. And then you who own the house are just an ancillary benefit. But getting your own insurance gives you the choices. You want to pay off the house or not? Right? I can tell you right now. I'll give you a scenario right now. Okay. And I advise this to Sandra, right? I buy a house in today's market. Today's market is pretty high. Would you agree? It's pretty high right now. I buy a house. My house right now that I'm in right now is valued at about 450. I buy it. Let's just round up 500,000. I buy it. Boom. Okay. 10 years from now, that market crashes. My house is now only worth 200,000. 200,000. Boom. Out of the $500,000 mortgage, I've only paid off 100,000. So now I owe 400,000, but the value of my house is only 200,000, and then I die. She gets $500,000 in the death benefit. You know what I'm going to tell her to do? Walk away from the house. That's what I'm going to tell her. Walk away from the house. Like, why pay? No, walk away from the house. Because you can now buy that exact same house if you wanted to for 200,000. Like, just go buy a house. If you want to stay in the same neighborhood, go buy a house in the same neighborhood. Go buy it for 200,000 instead of paying off that 400,000. Why? Because let the debt go. If she's not tied to the debt, she's not on the loan, she's not anything in that capacity, let the debt go. Let the debt go. The bank will write it off as a loss. She can go ahead and get herself into either the same house for 200,000 or spend 400,000 and get herself a better house. She wouldn't have that choice if it was just PMI insurance. Now, granted, I'm going to tell you this. I'm educating you guys right now on a more detailed level. I don't have these types of conversations with every single mortgage protection meeting, but to give you the tools that you need in case someone asks, it's a good situation. And notice what I typically do is I give them a scenario. People understand concepts when you can explain a scenario, where they can attach it to a scenario. What if you buy the house at this amount and then the market crashes? Look at the numbers. Boom, 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 boom. If you need to write it to show it to them, do it. But they need to understand the difference. PMI insurance just protects the lenders. It reduces in the amount it'll pay out, and it'll only pay out that mortgage. It doesn't give you the choice. Having your own insurance keeps the same high face value there and gives you the choice of deciding what you want to do with the money, pay off the house or walk away from the house, but it's your choice. 100% your choice. Okay? So now that you understand the consumer that fills out that questionnaire, now we're going to talk about what products are we trying to sell. I'm thinking of 3 products. I'm not going to tell you that there aren't other options. I'm not going to tell you that I haven't sold IULs to a mortgage protection lead. I have. But initially, my thought process is there's going to be 3 solutions that they're going to take. What are the options? Solution 1, term life insurance. A 30-year term life insurance policy, plain vanilla, living benefits, submit it, simple to understand. How does a 30-year policy work? Mr. Client, how old are you right now? You're 30. You're 32 years old right now? Okay, so from 32 to 62, 30 years, you're protected. You just got a mortgage for 30 years. So you're paying this mortgage from 32 to 62. You see how it attaches itself? Perfect. You make your monthly payments to your term insurance policy. If you pass away, your family gets the death benefit. But Mr. Client, this insurance policy also carries what's called living benefits. So guess what? If you don't pass away, but you develop a sickness and illness that stops you from being able to work, like a cancer, a stroke, or a heart attack, and you can't make that mortgage payment, guess what? This insurance policy is going to give you cash that you can use to pay that mortgage or put food on the table, pay the electric bill, pay whatever you need, right? If you need a nurse to take care of you, the living benefits trigger, and you can use that money to pay for the nurse and pay for your living expenses. Mr. Client, do you know that your private mortgage insurance, your PMI, doesn't do that? It will not give you money if you're still alive. You got to actually pass away, right? Bam. That's term life. Very cost-effective Toyota Camry type solution. The next solution after that, you know what it is? It's a term insurance policy with a return of premium rider, right? Again, we're talking mortgage protection. This isn't my normal fact-finding, getting to know an average client. This is a mortgage protection lead. I want them to know that I'm focused on what they wanted to talk about. yes, towards the end of the meeting, I'm going to address retirement. I'm going to address credit repair. I'm going to address all of that stuff and try to see if I could find other ancillaries. But I can tell you this, with my experiences, people respect if you're coming to focus on the problem that they wanted to focus on first. Don't come in there talking about, you see them having 4 or 5 kids, and then you spend your first 20 minutes talking about kid IULs when they wanted to talk about mortgage protection. Handle their first problem and then address all the rest of them later. So first term, second term with return of premium. How do I solicit that? I say, listen, you know, what if you could do this? You got a 30-year mortgage, Mr. Client. What if you get a 20-year term policy? Follow me for a moment. A 20-year term policy instead of a 30 years. And on the 20th year, I give you a refund of all the money that you ever paid into it. All of it. Now, you know what you can do with that money? You can pay the remaining balance off of your mortgage. What if I can help turn your 30-year mortgage into a 20-year mortgage, or your 30-year mortgage into a 25-year mortgage? How? Well, you sign up for a 20-year term policy instead of a 30-year term. It'll be a little more cost effective for you. On the 20th year, we give you a full return of all of your premium payments. Well, let's do the math. And I take out my calculator from my phone typically. I don't bring this 1987 calculator, although it's my baby. This bad boy has crunched many, many numbers. But, you know, a 20-year term ROP, return of premium, it's going to run about 140, 150 bucks, let's just say. So let's say 150 bucks a month times 12 months, 1,800 a year for 20 years. Mr. Client, that's $36,000, right? What if you could, on the 20th year, dump $36,000 into the remaining balance of your mortgage, and now you cut your mortgage down from 30 years to 25 years, or from 30 years down to 20 years, and you pay it off, right? It's pretty cool. It's almost like, it's like savings. Instead of applying that extra 150 towards the additional principal on your house, you're attaching it to an insurance policy that says, heaven forbid, if you don't make it to the 20th year, you die in the 4th or 5th year, the house is paid off. But if you do make it, here's all of the money you paid in, pay down a big chunk of the principal of your home. Pretty cool. That right there would be my Lexus. That's my second option. My third is a GUL. My third option is a GUL, a Guaranteed Universal Life. Why? Because a GUL through a company like North American, or a GUL through a company like American National, those are the two companies, offer a return of premium in the GUL as well. They offer it. So how does a GUL work? If the client's 30, I'm going to protect them until age 100. 70 years of coverage. Not 30 years like a term, but 70 years of coverage. But on the 20th year or the 25th year, remember that, on the 20th year of the policy or the 25th year of the policy, the client has a choice. Cancel the insurance and get a full refund back, or don't cancel the insurance and keep making your payments. But Mr. Client, you have the same choice as the Lexus you do now in this Ferrari type of a solution. You could get a full refund on the 20th year or the 25th year if you like, and pay off the remaining balance. But if you don't want to, Mr. Client, you keep making your payments and you know that your mortgage is covered. And guess what, Mr. Client, after the mortgage is paid off, if you want to continue to make that payments and treat that insurance policy as a legacy, knowing that it doesn't expire, you can keep making the payment and you'll have the coverage until age 100. And maybe now the purposes of that insurance wasn't to pay off the mortgage. Maybe now the purpose of that insurance is to leave a legacy behind for your family, replace your income. Or you can use it as a long-term care insurance policy when you're in your 70s and 80s. If you need a nurse to take care of you, can tap into that money to pay for the nursing expenses. Term with ROP, GUL. Every one of them focus initially on what? The mortgage, the mortgage, the mortgage, the mortgage. Now, if the client is showing interest in a GUL, I know they have the money to spend monthly for it. If they show interest in that, somewhere along the way, I'm going to start talking about an IUL as well. I'm going to start showing them the difference between. And you know how I typically do it is while I'm talking about the GUL, I go, you know what? I've got a better idea. Let me show you what I just did there. Again, this is, you know, salesmen are failed actors. Is how I look at it. A salesman is a failed actor, right? So if I know that if they're leaning in towards the GUL, once I've explained those three, if they're leaning in towards the GUL as an option, as a solution, I know they've got the monthly discretionary dollars. Then what's going to happen is while I'm talking about the GUL, at one point I'm going to go, wait a minute, you know what? I might have a better solution for you. And then I'll start talking about it. What if I can get you a policy actually that gives you more money than what you put in? See, the GUL gives you the money you put in back, dollar for dollar, guaranteed. What if I could give you an option where you get back more money than you put in? So now it becomes an asset. It's actually making you money more than what you put in. Would that be of interest to you? Yes, it would. It'll cost a little bit more than the GUL then. The GUL is running you at 150. This will probably run you about 200, 220. But you'll make more money than what you put in. How much more? You'll at least double. I mean, over a 20-year period, you'll at least double what you put in. You know, but if you give it longer, I mean, I could triple it as well. I mean, you know, and it's tax-free. I mean, would that be of interest to you? Notice how I just did that. I kind of dropped that nugget, right? I haven't talked about an IUL. I haven't shown an illustration. I'm just kind of talking conceptually about some of the features that they would like. What if you can make more money than what you actually put in, right? The GUL gives you back 100% of your money dollar for dollar. What if you could actually get back more money than you put in? That would make it an asset now rather than expense. Roughly 20 years, I could probably double your money, right? 20 years, I could probably double your money. You give me longer than 20 years, 30 years, I could triple, quadruple your money. And it's tax-free. It's not bad, right? But it'll cost you, right? The GUL is about 150. This will probably run you about 200, 220. Would that be of interest to you before we dig further? If they say no, don't dig deeper. IUL is 100% based on a budget. A lot of people like to immediately come out with an IUL. Here's your solution. No. Why? Like think about this right now. Look, this afternoon, my 19-year-old is buying his first car. God willing, right? Yesterday we were out for, how long were we out? 3 hours, 4 hours. He was astonished at the kind of conversations that I had with the agent. Because you guys know, I don't know if you bought cars before. There's 1,001 hidden fees in there, you know, and so here's what I'm getting at. I know what his budget is. I know how much income he makes. I know what his budget is. I know what kind of cars he likes, right? If he could have his way, he would have a souped up Jeep on a lift. You know what I mean? A Jeep Wrangler. So what is this? The Sahara model on a lift. You know. I mean, I'm talking about decked out system, everything. That'd be a good $70,000 car. Let's just say, right? But he can't afford $70,000. So why am I going to take my afternoon today going to the Jeep dealership looking at those types of cars? If I know for sure I'm out of his budget. He's out of his budget. There's no point. So the same concept with the IUL. If we solicit the IUL as this Ferrari type of a product, you're not going to take somebody to a Ferrari dealership if they're on a Honda budget. It just doesn't make sense. You're wasting your time. You know what I'm saying? So don't show that to them. So when I'm talking mortgage protection, I'm going to start first with term, ROP, right? GUL. I'm going to measure them at that point. Mr. Client, a term probably about $30, an ROP probably about $100, a GUL probably about $150. Out of those three, based on the features that they offer and based on your current budget, which of the three is of most interest to you? Look at my script that I just said. Based on the features of these products and your current budget, which of these three are you more interested in? You got to ask them the budget as well, because if you say which of the three based on the features are you more interested in, they're always going to tell you the best one. Who wouldn't want the best one? But Mr. Klein, taking into account your current budget, which one are you more interested in? You know what they'll say? I love this GUL, but you know what? Right now, I just bought this house. We just spent $3,000 to relocate and to move. My wife wants to remodel a couple things. Like I think the term insurance is probably going to be the better option for me. Okay, no problem. There's no point now in talking about an IUL. There's no point in hitting harder on the GUL. Take care of what they want right there. Let them know, Mr. Client, this term insurance, just so you know, later on when the budget's, it reestablishes itself and stabilizes, and you're back to back to normal, we can turn that term insurance into that GUL or into that IUL, into something better, something that grows in cash, something that's more permanent. But we can address that next year when we do your annual review. Now you're just kind of dropping that planting that seed. There's other options for me. There's other options for me. But that's how I'm selling mortgage protection, guys. Term with ROP, GUL. So now you might say to yourself, okay, well, what companies are you bringing to the table? I'm very, something that I can tell you, I think probably Howard, out of everybody who's on here right now, is he on? I saw him on a little bit ago. Something I can tell you that Howard and definitely Nicole and maybe even Sandra right now would attest, because they're around me all the time. I'm very systematic. I do things the same way every time, the same way every time, the same way every time, the same way every time. Why do I say that? I say it because, let's see if I can phrase it the right way. I'm very systematic in the way that I sell, because I want to make sure that I'm bringing value to the meeting. And if I'm trying to change it up every single time, then I have to think about my presentation. But if I do the same presentation every single time, my attention can more focus on the emotional intelligence of how they say things, how they do, how they're responding, what their body language is saying. You see what I'm saying? That to me is enormous. I'm very systematic in my companies that I choose. I don't want to flip. I don't want to fumble. I don't want to fumble when I'm running quotes. I don't want to fumble when I'm trying to log into the carrier. I don't want to fumble when I'm talking about the features of a product because I don't know yet about that product. You lose a lot of credibility when you do that. But when you can talk to somebody, think about a time that you've talked to somebody about a topic that you're not very good at, you're trying to learn more about. It could be a professional like an attorney or an accountant or something, a doctor. And you just feel good because they're able to answer you like this, boom, boom, boom. Like, and they speak with confidence, with poise. They can tell you the yes, they can tell you the no confidently. You feel a sense of, I can trust this person. I'm talking life insurance. They need to feel they can trust you. But if you're going, well, I don't know, let me see which company, you know what I mean? You kind of stumble a little bit. That loses a little bit of your credibility. So here's why I say this. I'm very systematic. If we're talking term insurance, guys, here's the companies I'm leaning towards. I'm leaning towards either American National Term, North American Term when it comes to full underwriting. If I'm thinking simplified, I'm leaning towards Foresters Simplified, Mutual of Omaha Simplified, or Americo Simplified. Boom, boom, boom. I stay in my lanes. But Tony, what about the 50 other companies that we have? What about this? What about that? Listen, I stay in my lane. I stay in my lane. That's all. Those are the companies. If you want to go full underwriting, listen, we're going North American, we're going American National. If they happen to work in extremely like high risk type of occupation, like truck driver, people that get in cars constantly, things like that, I might then lean towards American National Life Group because they have better living benefits. And you might say, why don't you lean towards NLG initially every time? I'll tell you why. NLG is historically more costly than the other companies. And their cash accumulation on their IUL, I know we can do better with other companies than theirs. Not a bad company though. I mean, they're still in the top 3. And certain states, that's what you have to bring to the table for living benefits. Like California, you got to bring NLG because American National doesn't recognize living benefits in California. Now that is North American. NLG is your only option. And don't get me wrong, they're still in the top 3 category. Nothing at all wrong with that. Nothing at all wrong with that, okay? But off the top of my head, that's what I'm always kind of leaning towards if I'm not working a California market or a New York market. Term, Foresters, a term, North American, Anaco, American National for term, right? If I'm going simplified, I'm going to go Foresters, Mutual of Omaha, or America. Boom, boom, boom. Simplified, right? Foresters let you do 300,000 simplified, Mutual of Omaha 300,000 simplified, America 400,000 simplified issue. If I'm leaning towards the GUL, I'm sorry, let me go to the second one. The if I'm leaning towards the ROP, the return of premium, okay, I'm going Mutual of Omaha because they have a simplified issue plan with return of premium rider, or I'm leaning towards Americo. Now, Americo, will curveball you a little bit here. They have a term insurance with return of premium, but they have another product that I like a lot called the continuation plan. The way their continuation plan works, and just so you guys know, personally, we have this. Sandra has a policy in this one. It's a nice policy. The way it works is a 30-year term with living benefits, right? But on the 30th year, it turns into a final expense policy, 10% of whatever your original amount was. So if you have a $300,000 term for 30 years, that means that on the 30th year, it becomes a $30,000, which is 10% of 300,000, a $30,000 final expense policy that'll last the rest of her life. And all she has to do is keep the same payments going, keep the same payments going. I kind of like that. It's not a bad option to bring to the table. I pretty much only talk about it when the person tells me they're interested in the ROP option. That's when I bring it up. So if I'm talking my initial presentation, here's your term ROP, here's your GUL, and they say, I'm interested in the ROP, right? I go, okay, great. So let's run some numbers. By the way, there's also this other product. It doesn't give you an ROP, but it gives you final expense coverage for the rest of your life if you choose to do it, right? That's when I bring that. But that's the companies I'm leaning towards. GULs, North American, American National, hands down. North American, American National. Why? They're the only ones that offer the ROP rider in a GUL. They're the only ones. Is there other GUL companies? Yes, there are. But they don't offer the ROP rider. Right? Now, if the person, here's another thing I want to tell you, and it's a dance, guys. It really does require a level of emotional intelligence. You got to be able to read your client and figure out how are they responding to you. The biggest risk with a lead is this. There's no warm introduction. So you've got to work extra hard to really build rapport with them. Because if you act transactional, you could lose the client. Even though you might sell them, remember, you have to understand something. Whatever lead it is, wherever you got the lead from, I don't care if you got it from me, if you got it from another source, there's going to be 4 or 5 other agents within the next year that are going to be reaching out to that same client. And if you didn't build enough of a relationship with them, you could lose that business. You could lose it for $5 cheaper. I mean, literally, the next agent that calls could say, hey, I got that same product for $5 cheaper. And maybe it's not the same product, and maybe they're being grimy. But for $5 cheaper, you lose the client. But if you built relationships, sometimes there's no price tag on that relationship. So why do I say that? If you see that the person is being transactional with you, try to build relationship. If you see that the person is a little sketchy about, doing full underwriting, then go simplified. Go in and get out. It's okay. Go simplified with the person. If you feel like you can't really establish that type of a relationship with them, what makes you think that going through 3-4 weeks of underwriting with that client is going to retain that client? That client might next week, 2 weeks later say, you know what, this is too much work. I don't want to do it. But if you can get them approved in 5 minutes right then and there, and now everything's enforced, everything's in place, at least you don't have to risk losing that person throughout the underwriting if you didn't get a chance to build a relationship. Here's the tough part about this topic I'm addressing. Technical people will struggle with this because a technical person would say, well, Tony, tell me a scenario where that would happen. This is all about emotional intelligence at that point. If you want me to tell you where exactly I go simplified versus fully underwritten, I'm going to tell you right now, it's a case-by-case basis. I want to read that person. I want to measure that person out. I need the emotional intelligence to figure out, can I build a long-lasting relationship with them? And when I say that, will they last through underwriting? Because if the person is going to get, jaded, disenchanted during underwriting because of the underwriting process itself, and you're going to lose them, now you're not even helping their family by getting them covered. I'd rather sell that person a simplified issue policy. And I say that because some of you guys might argue and say, well, simplified issue is so expensive. Why sell them simplified when you can get them so much more if you fully underwrite them? Listen, I'm the first person to tell you, I don't believe simplified issue for everybody. I don't write a lot of simplified issue. I replace a crap ton of simplified issue. I think it's crooked if you're just trying to sell simplified issue across the board, knowing good God and well that there's 30-year-olds and 40-year-olds that are super healthy that can afford, that can qualify for fully underwritten products and get twice the amount of coverage for the same price. But, this is a big but. If I don't feel like I'm building that relationship with them, and I'm afraid of losing that person in underwriting because you can tell that connection's not there, I'd rather lean towards a simplified product and get them approved right then and there. Because once they're approved, it's enforced, it's done. They don't got to look at it any longer. Sometimes people are that way. Sometimes they're like, just give me some insurance. I just want to be done with this. I don't want to go through 3 weeks. I don't want to have to schedule time with the nurse. I don't want to have to dig through medical. I don't want all that. Just give me approved or not approved. So you got to read them. You know how I read them? I'm just very direct. That's all I do. I'm just very, look, we can go one of route. I can go this route, I can go this route. Right? I'll give you a scenario. I just had this recently happen. I had a guy on social media hit me up, interested in working in the insurance industry. He's making $500,000 in California already. And he comes on board, and like usual, what I always do, I go, listen, we have to have a financial analysis. I need to show you what it's like, being on the field. I want to make sure you're protected. He's like, oh, I have insurance already. I said, great. That means you're a believer of insurance. Let's take a look at that insurance. Let's make sure you're getting the biggest bang for your buck. The guy's 32 years old. Look at the scenario right now. Write it down if you need to. 32-year-old male, super healthy. Goes to the gym every day, non-smoker, super healthy. 32-year-old male. $500,000 of term life insurance with only 75% ROP. 75% ROP, that's all it has, no living benefits. He's paying $270 a month for it. What's the first thing that pops out in your head, guys?
Why? Too expensive.
Oh, it's expensive because it's simplified. So I say this to him. I go, look, can I be honest with you? Sure. I go, look, I could probably sell you another simplified policy and maybe save you 10, 20 bucks. Or if you're patient with me and you're willing to build a long-lasting relationship with me, I can get you twice the amount of coverage for the same price you're paying. But I'll tell you this, if I go the second route, I'm not going to give you an answer today or tomorrow. I'm going to give you an answer probably 25 to 30 days from now. Now, I'll be honest with you. Again, this is the part of me that is very honest. But look, now I'll be honest with you. If you're going to cancel on me 10 days in and I've spent 10 days worth of payroll to my administrative team, 10 days worth of underwriting it, then I'd rather not bring that to the table. If you're going to do this, it's because you're willing to give me the 25 to 30 days that I need in order to get you approved. But if you let me get you approved, I'll get you twice the coverage for the same price. I mean, right now you leave your family with $500,000. I can leave your family with $1 million for the same price. But you got to give me the 25, 30 days because I have to go fully underwritten with you, which means I have to have a nurse come. They got to draw your blood, take a urine sample. My team is going to probably ask you a handful of questions. It's not going to be as easy as this one was. But that simplicity that you just paid for is costing you $500,000 worth of coverage. So which path would you like to take? You saw how I'm just very honest. I'm very direct, respectful. I'm very direct about it. I want your long-lasting relationship. I want your patience for the next 25, 30 days. I want your agreement that you're going to answer my team's questions if they ask them, and you're going to be willing to take a medical. Because if you're going to give me issues over those things, then listen, let's just stay with the simplified because what you're paying for is the simplicity. What I'm offering you is paying for the quality. You pay for the simplicity or you pay for quality? Which one do you want to pay for? Look at that verbiage that I just used, right? That's a great marketing campaign too for social media. Simplified term versus fully underwritten term is the difference between paying for simplicity or paying for quality. Pick your pick, pick one, which one you want. And it's okay. Some people prefer paying for simplicity. I got an attorney friend of mine that's deathly afraid of needles. I mean, like pass out. Like he sees blood, right? To him, simplicity all day, every day. If he needs $1 million of coverage, he'd rather get a $250,000 simplified issue from 4 different companies than to do $1 million from one company if it means he can avoid getting a needle. I promise you. But I don't know this if I don't figure out their personalities. That's where emotional intelligence comes in. So anything you guys can do to invest into learning more about emotional intelligence and reading body language and reading tonality and reading their facial gesture. This right here says so much more. This right here says so much more than this. This sometimes lies. This never lies. And if you think I'm wrong, test it out for a week. If you're in a relationship, test it out for a week. For 1 week, read more of this of your partner than this. If you're in a good relationship, this and this are in alignment. When they're mad, they're saying they're mad. You can see they're mad. When they're happy, you can see that they're happy. They're saying they're happy. You want to talk about, a dysfunctional relationship? They tell you they're happy, but this right here says something totally different. Totally different. I promise you. This says so much, but this right here requires a different level. This is not book smarts. This is emotional intelligence. And in the world of sales, practicing this is so clutch for your sales. It is so stinking clutch. My last tips that I'm going to tell you is this. If there's husband and wife, meet with husbands and wives together. They both just bought a house. It's both equally as important to them. I said this earlier, but I'll say it again as a bullet point. Focus on what they initially came to you for. They came for mortgage protection. If you see that they got a $40,000 rollover, you see they got 3 kids and you got IUL opportunities there, you see that there's an opportunity for disability insurance, you see it, great, table it until you take care of the first thing. Take care of the first objective first. Don't let that person feel like you're looking at them as a freaking dollar sign, a floating dollar sign, because you're going to cross-sell and sell multiple things. Take care of what they need first. My last bullet point to you is this, and this is great for cross-selling. Okay, always do a budget. I repeat, always do a budget. You should have a budget sheet ready at your disposal every time. And if they ask you, why do you need this? Tell them, listen, I'm a fiduciary field underwriter. I have to present to this company the reason why this is a suitable recommendation to you, and your discretionary dollars is something they want to know that you can financially afford. So I need to do a budget on you. Do you really need it to sell a simplified policy or a term policy? You don't. You don't. But by knowing what assets they have and knowing what discretionary money they have every single month, you now know if there's other future cross-selling opportunities. And I'll tell you another reason. Even from a suitability standpoint, the insurance company might not require it, but you as a field underwriter should want to know it. I don't want to sell somebody an IUL at $250 a month when I know they only have $300 a month left over every month after they pay all their bills. That's a chargeback waiting to happen. I don't want that. I don't want to sell somebody a term insurance policy for $50 a month when they're super healthy and I know they got $1,000 left over every single month. I'm doing a disservice to that person too. I am. So the budget is important for cross-selling for suitability purposes. Those are my biggest bullet points for you guys. Biggest bullet points. If there's any homework I would have you guys do, here's homework. Ready? Go run some quotes. Go run some quotes on those companies that I just talked about. North American and American National, the GULs, you can run quotes on the callums.com website. You don't even need to have a contract number with them. Foresters is a mobile link. There's an actual mobile link you can run quotes for Foresters. There's a mobile link for Americo. You don't need contracts for those either. There's a mobile link for Mutual of Omaha. Now, Mutual of Omaha is not a link, it's an actual app. You got to go into your Play Store on your phone and type in Mutual of Omaha quotes, and you'll see the application pop up. You can download it. You don't need a writing number to run quotes. Play around with that. Get good at that. You can lose a case if you look like you're stumbling around in the meeting just trying to figure out how to run a quote. So play around with it, run it. Play around with it, run it. Play around with it, run it. That's my best advice for you guys. And if there's anything you guys can do to invest into emotional intelligence for mortgage protection, for final expense, for IULs, for everything in sales, emotional intelligence is going to be very big. Figuring out what their body language is saying, what their emotions are saying, that they want and that they don't want, let you really figure out the best way to sell, the best way to bring value. Does anybody have any questions before I finish off today? Anybody? I'll close off with this then, guys. I just bought a huge batch of leads. Huge batch of leads, guys. Hold on, let me tell you exactly what I have. Where are they? There they are. Okay. Age leads. Every single time we do an order, I always buy a bunch more because I want to account for other agents. I want to buy more leads. Okay. Is this count accurate, babe? Yeah. Okay. Good. Tennessee. I got 66 leads left. I bought a lot of leads, guys. Florida. I got over 1,000. Texas. I got over 400. California. I got a little over 200 in California. Arizona, don't have any more. Illinois, don't have any more. Nevada, don't have any more. Unfortunately, I don't have any more of those. But if you are wanting to make sales, these are all mortgage protection, by the way. Well, that's how I bought them. I can't guarantee that every single one of them. There might be a couple that slip in there that are final expense. But these are all mortgage protection that you can do either over the phone or you can do virtual. So whether you're in the state that I just mentioned or you're not in the state that I just mentioned, if you want more leads, I'm literally just $2 a piece. Take them. But what I bought them for, they're there. They're in my inventory, ready to go. Literally, you know, as long as Sandra and I aren't occupied, we can email them over your way. But give me at least 24 hours. Don't be that agent that's like, I bought them. I waited 5 minutes. Where are they? Like, hold up. If you want them, hit me up. Let me know. I'll send you the order link. You can submit it in, and I'll send those over your way. But there's $2 a piece, y'all. Think about it. Think about it. $250 worth of leads gets you 125. $500 worth of leads gets you 250. You spend $500, get 250 leads, and you make one sale out of the 250. You just got back all of the money you invested plus a profit because you're going to make about $1,000 per sale. That's what you're going to do. You can't make one sale out of 250 leads? I think you can. Leads work as long as you work them. Leads work as long as you work them. And if you're trying to work them, I'm telling you right now, if you're trying to work them without using our Jarvis CRM system, you're shooting yourself in the foot. Our Jarvis CRM system does 12 weeks worth of text messages for you. That's like a virtual assistant. 12 weeks worth of text messages, voicemails, and emails on your behalf. All you gotta do is upload them. Take advantage of it. It's like $52 a month for that service on a month-to-month type basis. All of these resources are there for you guys to take advantage of and really go out there and kill it and go make some sales. Carlise said, so we just send you, I'll send you the link now, Carlise. Not a problem at all. I'll send you the link now. You can place your order right there. Remember, because I know Carlise, you're in California, they're state bound. Cali's huge. Okay. So they're state bound leads. You got to get very good at scheduling virtual meetings and phone meetings. You know, I'm not telling you that there aren't going to be leads that might be in your county and close by, but you know, you could find some that are several hours away, but $2 a piece and they work phenomenally. We're getting a lot of people making sales out of this stuff. And listen, when you go back in for the deliveries, when you can cross sell, sell other things, because you've already built rapport with them, you already built trust, you already took care of their needs. Now you can cross sell and sell more things. Okay. Carlise, I'll help you out, no problem. We can schedule like a phone zone and stuff. I would recommend this though. I would tell you for sure, definitely get Jarvis. You're a VP. Jarvis is a little bit more for VPs because it does more things for you VPs. It's $75 a month for a VP, 5% fee, $78, I think, something like that. But it's well worth it. And it's more money for VPs to have Jarvis, which is the CRM system, just because it does a lot more tracking, a lot more back office stuff than a regular Jarvis account for non-VPs. But I would definitely encourage you, if you're going to buy the leads, get Jarvis, because you especially, you work in a government building, you're busy during the day. Letting Jarvis text message and email and voicemail all of your leads for you while you're working. And the cool thing is, if people reply, Jarvis sends you a text message. Literally, you'll look at your phone, get a text message, and you'll see, hey, Carlise, this is Jarvis here. Just so you know, such and such person, responded to one of the messages. Log in and take a look and see what they said. And sometimes what they say is, yes, let's talk. Sometimes what they say is, hey, piss off, I'm not interested. But at least it's filtering out for you and doing a lot of the legwork for you while you're occupied with, your other obligations and such. And that's why I created it, is to give everybody speed. So If nobody has any other questions, guys, you're free to hop off. Hopefully this helped you guys out. And now it's just a matter of getting on the field and scheduling meetings. You know, a lot of people hound me down a lot of times about scripts on the phone. Guys, I'm just honest. How are you? Nice to meet you. My name is Tony Martinez. I'm a field underwriter. I'm calling because you recently made an inquiry over the need for mortgage protection leads or some type of insurance. If you got 2 minutes, I'd like to ask you a couple questions to see what to let you know what you qualify for based on the state you live in. That's my script. Guys, that's the script. It's simple. I'm not interested. Not a problem, sir. Have a great day. Right? And the ones who say they're not interested, just so you guys know, you know what I do? I drop by their house. Because people are very different over the phone than they are face to face. But you know what I also bring with me? I give them a goodie. It's very hard for people to be rude to you when you're giving them something for free. It is. And you know what's the best thing to bring? You ready? Food. Food. You guys think I'm playing with you, but I'm being dead honest with y'all. Like, go to a little Spanish bakery, buy yourself a couple of those little pastries. They put them in the little white boxes. Buy like 10 of them. All you gotta do is put one little thing in there. A little cake, a little flan, like $1 pastry. We'll knock on 10 doors. Hi, how are you? Nice to meet you. My name is Laura Ramirez. I'm your local field underwriter. I just wanted to stop in. I'm in the area here. Here's my business card. I wanted to bring a treat just to kind of say hello. I knocked on your door because you made an inquiry over life insurance, and I wasn't sure if somebody took care of that already for you. You'd be amazed how many people, oh, thank you so much. And now because they said yes, they took the free gift, they somewhat feel obligated to have a conversation with you about insurance. Oh, I have insurance already. Listen, that's perfect. I'm so glad you said that to me. The department that I work in specializes in helping existing insurance holders save 20 to 30% on their existing premiums. Have you been able to save 20 to 30% on your existing insurance? No? Let's talk for a moment. I can help you with that. Right? Like, there it is. There it is. I didn't sign anything. I didn't request anything. I can understand that a lot of the times, sometimes it might not be you who requested it, but maybe a family member requested it, but definitely somebody requested it. Is this your name? Is this your address? Definitely somebody filled out this information requesting insurance. You happen to know who that person might be? Right? Oh, and just so you as well know, I also help with credit reparation. I help with, I help with retirement planning in case that's of need to you. Guys, I don't kill myself with too many objections. You know why I don't kill myself with too many objections? You can't stop somebody who's willing you can't stop somebody who's willing to knock on more doors than rejections. You tell me no, I'm just gonna knock on another door. You tell me, you hang up on me, I'm just gonna call another number. And at $2 a lead, listen, I promise you, I got no time to deal with someone that wants to give me 5 objections or wants to be rude from the very beginning. Click next. Click next. That's the benefit about being independent. That's the benefit about being your own business owner. You can pick who you work with. You can pick who your clientele is. Simple as that. But my only request is, if they said no to you on the phone, don't think that no really means no. Sometimes, you just gotta knock on the door and say hello. That's it. Gentlemen, how many times, in high school did you ask a girl out, she said no, but you decided you wanted to try again? Same thing. She said no, don't worry. She's got to warm up to me, is it? She's got to warm up to me. I'm going to bring flowers next time. Right? Like, they said no to you on the phone. Go knock on the door. Now, don't get me wrong. I'm not telling you to schedule a day of just going to knock on doors of people that said no to you. What I'm saying is, when you leave to the field and you got 5 meetings, bring with you your lead list. Highlight the addresses that are close by to the places that you're going to be at. Because I promise you, 1 to 2 to 3 of those meetings are going to cancel. They never all keep. And when the ones that cancel, rather than you sitting around twiddling your thumbs, go knock on a door of somebody that is in the area that filled out, that's a lead on your list. Go knock on the door. Hell, another thing you could give them is the Kaizen Soulmate packet. You don't got to give them a pastry if you're against that whole concept. Print out a couple of the Kaizen Soulmate packets. Go to Staples, go to OfficeMax, invest into yourself, print it out on a nice paper, bind it in a nice comb, The Kaizen Soulmate packet is a legal packet with, you know, your last will and testament, your medical care directive, your power of attorney documents, and assets in a balance sheet, an emergency contact list, and a blank sheet of paper where you could write a message, a letter to your loved ones as though that was the day you were going to pass away. It's a great little packet. We have that. You can attach your business card to it, give that. Mr. Client, listen, I have this state-approved legal packet that allows you to have a will and testament, a medical care directive, and a power of attorney. You can use this for your existing insurances or anything that you purchase in the future. This is something that I wanted to bring to you. I'm your local field underwriter. I just wanted to get 10 minutes to talk to you about this request you made over insurance protection. Some people will say, yeah, come in, I want that packet. Give them something and you'll see they'll respond differently. It doesn't have to be really expensive, but invest into yourself. Anyhow, I'm going to get off, guys. I'm going to let you guys go. You're free to hop off. I'm going to stay on like I usually do for another minute in case there's any questions, but you guys are free to hop off. I appreciate you letting me go over by 20 minutes on training today, but I thought it was valuable that we talked about that. Have a good one and be blessed. And if you are watching this video and you want to learn more, hit me up. I'll give you my direct number, 239-784-1118. I'll repeat, 239-784-1118.